If you trade with Bollinger Bands, you've probably learned that textbook rule. When price hits the upper Bollinger Band, you sell. And it looks like a perfect setup on the chart a lot of times. The candles are pushing into what looks like resistance. The indicator is flashing over bought. And it feels like a pretty simple, profitable short trade. It's just sitting right there. But then the trade goes wrong. Price does not reverse. It just keeps climbing. It blasts right through the upper band, right through your stop loss. And now you're thinking, what just happened? Well, that is a common misunderstanding, and it's why a lot of traders that use Bollinger Bands are using them incorrectly, and it's probably costing them money. So in this two-part video series, I'm going to show you the adjustments and the overlooked techniques that separates profitable traders that use Bollinger Bands from the rest. And you can stop falling into these traps. So the common Bollinger Band mistake, well, first let's get on the same page here. What are they? Well, at the core, they're a volatility indicator. You have a 20-period simple moving average as the center line. You have two outer bands plotted above and below it. And these bands are usually set at 2 standard deviations from the middle line. So it creates like an elastic envelope around the price. So when things are quiet, volatility is low, the bands, they squeeze together. When volatility picks up, they expand. Now, the foundational myth that's often taught is, well, sell at the upper band, buy at the lower band. And that's presented as a pretty simple oversold, overbought trading strategy. And the logic, it makes sense, but it's a massive oversimplification because it completely ignores the single most important factor in the market, momentum. And here's the truth. In a strong trend, the upper and lower bands, these are not reversal signals. They are signals of strength. They are signals of continuation. And when price is constantly hammering against that upper band, the market's not just overbought, it's really bullish. And if you're trying to short that, you are literally standing in front of a freight train. The bands are telling you, here's extreme strength. And the common strategy tells you to bet against it. And if you have ever been burned by this, do me a favor, hit that like button. Now, the first fix, master the squeeze. And this is the real foundation of using the indicator correctly. Instead of hunting for reversals, we're looking for periods of consolidation. And consolidations happen when? Right before big price movements. And a squeeze is pretty easy to see. So when the upper and the lower bands tighten up, they move closer together. What does that tell you? It tells you volatility is drying up. The market is getting quiet. It's coiling like a spring and it's getting ready for the big move. And the longer and tighter that squeeze, the more explosive that potential breakout. But just finding that squeeze is not quite enough. And here's a pro tip that many people miss. Add in the bandwidth indicator to your chart. It literally measures the distance between the bands. And when you see the indicator drop to a multi-week or even a multi-month low, you know you are in a prime squeeze setup. It's the kind of setup that can lead to massive and account-changing moves. So how do you trade that? Well, you just wait. Let the market tip its hand. The signal is a strong, full-body candle that closes outside the band after the squeeze has been going on for a while. A close above the upper band, that's our signal to go long. Below, it's our signal to go short. But there is one more piece to the puzzle, and if you ignore this, you're going to get faked out a lot, and that piece is volume. A real breakout, the true start of a new trend, has to come with a surge in volume, and that surge can be a simple volume expansion compared to the previous day or the previous 3 days. Look at the volume at the bottom of your chart. If that candle is breaking out, but the volume is weak or it's just fizzling out, it's probably a trap. But if that breakout candle comes with a huge volume spike, that's like an A+ confirmation. The market is screaming, this move is probably for real. Now, walking the bands. So we're going to circle back to that trade that went wrong in the beginning. That's the one that looked like a perfect sell, but just kept going higher. And the reason that happens, it's a phenomenon called walking the band. And once you understand this, you're going to save yourself from a lot of bad trades. So when a market is in a powerful, sustained uptrend, for example, the price is going to consistently touch or even ride along the upper Bollinger Band. Now, let me be clear. This is not your signal to sell. It is a sign of extreme persistent strength. You try to short that, you may as well just give me your count. The right way to see this is to recognize, hey, I'm in a strong trend. The market's telling you, I want to go higher. And your job, it's not to fight it. It's to figure out how you can join it. So the rule is pretty simple. Don't start new short positions when a stock is walking the upper band, and you don't go long when it's walking the lower band. So how can we use that? One way is to manage your winning trades. If you're long and that price starts walking the upper band, don't be in a rush to sell. The market's telling you there's more gas in the tank, but adjust your stop, because when that band walk ends, it often does so with some force. So try to keep it tight. You can also use that middle band, that 20-period moving average, as your guide. So in a strong uptrend, that's walking the band, pullbacks to the middle line. These are often great opportunities to add to a position or get in on the trend. But to do that, you have to know what makes up a good pullback. And to learn that, the video is linked below. So there's a lot more I want to cover. In the next video, I'm going to reveal advanced Bollinger Band setups and techniques that can take your trading of the Bollinger Bands to the next level. So make sure you hit subscribe, hit that bell so you don't miss part 2.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.